Hello everybody, welcome to tonight's webinar on intangible assets under ASPE and IFRS, and this is a level A depth competency from the CPA competency map knowledge supplement. And I think it's actually really important for us to understand the difference between what is a depth topic versus a breadth topic. But just before I begin, I want to make sure if you guys can hear me. How is my sound? If you can let me know in the chat. The copyright of the standards belongs to CPA Canada and other provincial CPA bodies from the CPA Canada Handbook. The interpretations below are my own personal opinion and all rights are reserved. The opinions below are my own and are not to be relied upon. The information provided below is for illustrative purposes only and is not advice or guidance. Prep Formula is not affiliated with or related to CPA Canada, CPA Ontario, and other provincial CPA bodies representing and regulating chartered professional accountants in Canada. Prep Formula's activities have not been approved or endorsed by these bodies. Okay, excellent. Great to know that my sound is okay. So I know there was a little bit of a confusion of whether or not there was a webinar tonight. I kind of just got a little bit of notifications. I thought it was actually canceled. There was some, overall just confusion in terms of the communication. But either way, I am jumping on board now, and I appreciate your patience for me to kind of get all set up. Please do make sure you go into the webinar materials and get the content there related to tonight. The slides are all there too. And I am your session leader for tonight. I have been teaching for quite a long time at U of T and the CPA. I'm also an independent contractor and a professional marker for them. And so I hope to be able to provide a lot of my insights and advice to you. And tonight's session, I think intangibles is relatively a straightforward topic, but most people kind of misunderstand the topic, and I do want to make sure I can go through that with you. Okay. So before we begin, I want to make sure that now is actually approaching some pretty big crunch times. For those who are going through your cores and your modules, your exams probably in about a month, and it's really important that you spend the time and work through your and work with your mentor really early. If you're going through the CFE right now, it's not clear whether or not they are going to hold the exam. They have every right to update, and that information changes quite regularly, but they are currently, everybody has gone through Capstone 1, and they also are starting to enroll for Capstone 2. So there's still indications that the exam is going to be, and I would highly suggest that you still continue your studies and preparations along that way. That is my opinion. If you're an international individual, this is something where you need a lot more time compared to I would call people who have gone through the PEP process, because they're a little bit more used to the style, and there's a little bit of a misnomer to think that you can cram for this exam. To be very candid with you, this is not something you should cram for. The exam comes for 3 different styles. You've got 3 different days that you're writing, and this takes actually a lot of time to properly prepare and train. Okay? And so this is where you want to make sure you reach out to your mentor early and get into contact on developing a plan together. And this is what I've been working with a lot of my mentees and what we work through. Especially, the core and modules, the exam style has changed, and the way you prepare is different. How you write 2 cases is different than how you write 1 case and multiple choice. So this is very important for you to understand when it comes to that stage, and this is part of it. The webinar is part of a component to your study plan and improving your technical around that. Okay. So the first thing I want to make sure that you do get is this Prep Formula study guide by emailing support@prepformula.com. If I do go too fast, this webinar is recorded, so you can watch it again. The study guide looks like this. Okay. And since we're covering intangible assets from IFRS and ASPE, I do want to make sure that you know how to read the handbook from IFRS and ASPE. And this is where, if you go to the table of contents and you go into financial reporting competency and you click this, there here is written on how this guide is to be used for financial reporting. And when you're working through financial reporting, your analysis needs to cover these components. This actually more so is important for intangible. People underanalyze intangible. I cannot emphasize how little or how much how deficient the analysis when it comes to intangible. Okay, so we're going to work through that here, and I will just use ASPE as an example to work through it, but the same applies to IFRS. Okay. There's also, since you're using financial reporting, the competency map says that the technical difficulty on this topic is a level A and in depth. So the difference between breadth and depth means when it comes to depth, you are expected to use a lot more analysis points to hit and score. Okay, it's not just about scoring the answer. People think that, especially on day 3, when you do your analysis for case writing, I just need to give you the answer, whether or not I need to capitalize or expense the intangible costs. Okay, that the key when you're doing the analysis for intangible is for you to work out and be very thorough in terms of the analysis of the points. Okay, and this is what I'm going to demonstrate tonight after we kind of go through some of the technical material. So a couple of other things to go through. How do you read the handbook? Well, when you're going through the exam, you will actually get opportunities to use the handbook. This is part of the guide. Now, if you don't know how to use the intangible asset handbook guide, that is a big problem. But what you should know is, how do I know how much to analyze? That is a very valid question. When it comes to intangible, I will say it's the most frequently tested topic. It shows up the most on the exam, and it's, to me, the most straightforward to do. Actually, what people will have a lot of trouble with is actually dealing with it in time. And that actually takes a little bit of practice, but we're going to illustrate that today. And so when we need to go through depth, I'm just going to show you the handbook that you guys see. So this is the NOSHA version, okay? And if we go into the handbook, let's start with private enterprise, IFRS first. So if we go to IFRS, I want to make sure you use the exam reference version. So in the exam reference version, you actually will get the most relevant standards that you would deal with when writing the exam. Okay? And so when we go through that, let's go through to the section for intangible, so IAS 38. And I want you to pay attention to see there's the definition, there's intangible assets, identifiable, control, future benefits, recognition and measurement, and then they have the development phase. So let's go through the development phase, and you can see these 6 criterion are bolded. Okay? When you're creating your own study notes, or you can use the notes that are already here, when it comes to IFRS, the content that you're pulling is always highlighted in bold. This is not always the rule, but it's something that's easy to follow. So you can see intangible, we have the rules right here. So development costs is right here. Actually, commonly what's missed is most people only just do development costs. What they end up missing is the part up above when it comes to identifiability. So there's criterion here. Okay. Control, there's no criterion, but there's a very important paragraph right here, paragraph 13. And then future economic benefits, there's an important paragraph here. And then also, when you get to recognition and measurement, there is some important criterion here. Okay, so which is actually described down in the bold down here. Okay, so you can see it's not always, right? So it's like, let's say future economic benefit, it's not that, but it's not bolded. But how do I know that this criterion is important? If you look at the index, you'll see bold, and then you see the unbolded. These are the criterion that you need to talk about. And then you have recognition and measurement. Well, once you kind of get there, you're going to go through the development phase, and then you click through that right here. Okay, so it still takes a little bit of familiarity to get used to, but once you know how to use the handbook, I don't memorize all of these criterion. I just know there's 6 criterion, and if the case is IFRS 16, I will know when I hit to this the points where I need to use 6 criterion, I know where to jump to, which is paragraph 57. Okay. Now let's take a look at the same situation as if it were ASPE. So ASPE, we go into standards. We go into 3064. And then again, it's no different. So intangible assets from an IFRS and ASPE perspective are aligned. And if you go through this detail here, intangible assets, identifiable, control, future economic benefits, recognition and measurement. Okay, so just to kind of tie it all together back here, definition, recognition and measurement, okay, and then subsequent measurement we'll talk about, and then development phase. Okay, so development phase, if you read the handbook, we're looking for italicized text. And if we go through the development phase, there's this part, but met in the provided criterion. So let me just kind of expand this so you can see. Oops, I lost it. Okay, provided criterion. So you see how it's italicized, and then met provided 41. So this is not italicized, but because of the italicized section, it guided me to come here. Okay, so this is where this is the key to kind of understand. Okay, when it comes to intangible, I think it's really straightforward because you just need to pull and remember. Oops. You've just got to pull the right criterion, and it's consistently the same, especially since it's a level A depth topic. So create your answer structure already and get used to answering this. This is something that shows up almost every single year. Okay, it's very popular in the cores, and it's also very popular in the module, and also very popular in the CFE. Okay, now this is in a class related to exam strategy. This is something that I work with my mentees individually, but something that you again need to talk to your mentor to go through. Okay, so hopefully I've kind of laid the land in terms of gaining the technical knowledge when it comes to working on the ASPE and IFRS for using the handbook, the knowledge side. So let's go back to the content. So using the handbook, explain that. So let's talk about intangible assets. So these slides, you have the availability to print them. I actually recommend and suggest that you do print them. Okay. The reason behind that is because over here, these are the first criterion that you need to include: identifiable, control, and recognition. Okay. So identifiable is, can you identify it? Is there an invoice, or is there some way for you to determine there's some intangible exists? Okay. If I was a software developer writing a program of code, identifiable is a little bit hard. Do I measure the amount of hours the software developer is paid? But if the person is paid, let's say 100 grand salary, who's writing multiple lines of code, how do I determine if that's identifiable? Okay. Do I have control? Well, if I write the program and the code, I have control over that, right? It's the control of the business, owned by the business, and recognition. So it's recognized if and only if it is probable that the expected future economic benefits will flow to the entity. This is really important. So there's times where people don't understand the recognition criterion. The recognition criterion for this component is it has to be probable future economic benefits will come. And so tonight's example, I will definitely dissect this part, particularly because a lot of people get confused on this concept. Okay. All right. Then, when it comes to working with intangible assets, actually one really important thing to recognize is internally generated assets. You have a policy choice. You can actually capitalize or expense it, provided you set your choice. But when it is the first time that the entity needs to make this accounting choice, something to think about is whether or not you need to expense it or you capitalize it. So what are the consequences of choosing either expense or capitalize? The first one is when there's a policy of expensing as incurred, this makes the whole thing much more simpler. Okay, it simplifies the accounting, net income. You just write it off, right? The balance sheet effect. So the thing to think about is naturally most people will try to work through that depth of the analysis, which is actually quite important to do. But when you make your recommendation, even though the criterion can meet to be capitalized, you can actually decide to expense it based on policy choice and based on the needs of the business. And again, we'll kind of tie this together in the example that I'm going to use tonight. Whereas capitalization, you go through the process of working through all that criterion, and then you capitalize it, right? And under ASPE, again, remember, you have the choice to capitalize or expense this. Okay? In IFRS, you work through the criterion, and it's quite clear-cut in that. Not clear-cut, but it is usually you've got to be consistent in the conclusion. Okay? Now, what happens if you're dealing with research? So the first thing is you want to identify the costs associated with research and those with development first. And here again is the definition related to research, and I want to pull that up from a ASPE perspective, so you can see ASPE. So research, again, you can see the handbook criterion. Oops, lost it again. In the research, you see how this is italicized? That's what you would copy into the handbook. Or you can take a simple approach related to research as per defined in ASPE. The research expense, cost should be expensed. Is there a difference of what you choose between copy and pasting or writing in your own words? I think it's important for you to recognize, this is my opinion, the limitations of each, right? So if you are copying and pasting, you will get everything that you need to address, which is to me a very big advantage. But sometimes if it takes you a long time to find it, or you're not familiar with it and you have to fumble, that might not be something you want to do. Or if it's something or of an assessment opportunity that you have a lot of experience in dealing with, maybe it's faster for you to type. So then you might make that decision. This is actually something that you definitely want to stay in contact with your mentor to work with and decide and figure out. Okay. And then just going back to the slide. So now if it's development, it's related to application of research findings. So the difference between research is you don't have anything set. Okay, it's kind of exploring, like you're discovering. I don't want to reuse the word research. You don't actually have anything in place. You have some idea, but you don't know if is feasible. It's going to work. That's research. Okay, development is you know what you're going to do. You have an idea of how it's going to look like. You have maybe 3D printed it. You have a model in place. Whatever you're building, it's there. Okay, so just using software as an example, you don't know if this software is really needed. So you write a whole bunch of code and you kind of pass it to potential customers to see if it works, and it doesn't. And you scrap it. That's really like research, okay? But if you already have a product in place and you are refining it and people are already generally using it, development, that then already pretty much qualifies as development, okay? One really important thing to recognize is internally generated brands, titles, customer lists, and other items in that substance. They're not generally recognized as intangibles because those expenditures you can't distinguish from the cost of developing the business as a whole. And most people usually will not capitalize those items. Again, because if we go back to the initial definitions that we saw earlier, can you identify it specifically? Do you have control over it? And is there a clear recognition of benefit? Okay, future economic benefit. And then internally generated goodwill is not recognized as an asset. I've started quite a few companies working on it, spent many hours. Do I get to add that value into the business? No, unfortunately not. And that's called sweat equity, okay? Unfortunately, I didn't get paid for it until the business sort of generated enough momentum. But internally generated goodwill is not considered an asset, unfortunately. So what if we now need to decide on these costs, whatever these costs are, when you capitalize as part of the development criterion? First of all, there are 6 criteria to be met. They are generally the same for IFRS and ASPE. So if I remember, I've got to work through definition, recognition, and then measurement, and then eligibility, which is the development criterion. On that development criterion, there's 6 criterion. I just remember there's 6. So I just go to the handbook and I copy and paste those 6. And maybe I'll just demonstrate that tonight. So the technical feasibility of the intangible asset so that it'll be available for sale, that one's relatively straightforward. Do you have the expertise to bring this product available? So I could say, hey, I have the source code for this software, but I actually don't know how to program it, so I don't have technical feasibility. I have useless code. It's kind of there, but it's not, and I can't finish it, so there's no technical feasibility. Intention to complete the intangible asset and use it or sell it. So, I don't know if anybody ever watched Steve Jobs, keynote videos. And when one of the stories was, he was in development of the iPad first, before the iPhone. And as he started to make new discoveries, he started to take the iPad development and he shifted it to the iPhone because, they were able to do more things with it, and that was the more game-changing product. And so the iPad, you can argue there's no more intention to complete it, or maybe at a very much longer date. And the iPhone became much more larger intention to complete that intangible asset. So basically the mold and the model to build the first iPhones. Do you have the ability to use or sell the intangible? If you can clearly identify it, I think it's quite easy and clear to sell it. The availability of adequate technical, financial, and other resources to complete the product. So this is on, to complete the development. This is whether or not you have the resources. So aside from technical feasibility, whether or not you can do it, do you have the resources, the right people? Do you have enough money to fund it and all of this stuff? Then you can actually generally capitalize it, okay? And then it is, the next criterion is the ability to measure reliably the expenditures. So reliably, especially the auditors that are watching this session, reliably is generally proven by invoices or contracts or some measure on those lines that's very clear. Okay, if you're doing if some programmers are just randomly logging in hours and then just typing in some code, that's a little bit tough. That's why internally generated intangibles are harder to prove. And then the last one is how the intangible asset will generate probable future economic benefits. The key is how the intangible asset will generate probable future economic benefits. So the entity can demonstrate that there's a market, the output of the intangible asset or the intangible itself, or if it is to be used internally, the usefulness of the intangible asset. Okay? So how can you measure the cost of an intangible? The cost comes from any expenditures incurred from the date when the intangible asset first meets the recognition criterion. So that's from the first section. Okay? Expenditure on an intangible asset that was initially recognized as an expense is not recognized as part of the cost of an intangible. Expenditures comprise all direct costs necessary to create, produce, and prepare the asset. And then the last one is interest costs are also included when IFRS is used, and when ASPE is used, the entity's accounting policy is to capitalize interest costs to expenditures. So what do you really want to take away from this is, in the case, they're going to give you costs, and one of the most common errors that I identify is that they're given those costs, but they don't actually address any of those costs properly. Okay, so they don't say, this cost, expense, this cost, capitalize, this cost, whatever. Okay, if they're giving you information like that, you should look to use that information. Okay, so like a lot of the time it's actually quite obvious, but if you're not putting anything down on your response, it's not obvious to the marker. So that's just a small tip for you to take away. Now, when it comes to IFRS, we're kind of entering this other mode called revaluation model. Okay? But before I kind of go there, I want to open up, going back to the study guide here. So we've already gone through definition, right? So definition for an intangible, is it an asset or is it an expense? So that needs to be established, right? Recognition, do I have permission to record it? So that's going to be going through those three criteria we talked about. Then it's measurement. Measurement was the previous slide. All of those costs that we're talking about, what can you capitalize? What can you expense? Subsequent measurement, this is one component. Now, ASPE does not have revaluation, but IFRS does. Okay, so this is one of those topics that can be forgotten when it comes to analyzing your intangible in depth, the revaluation model. So the first part of revaluation model is either revaluation amount after initial recognition. An intangible asset is carried at the revalued amount, being its fair value at the date of the revaluation. So if you've capitalized the intangible, and by year end, you can find some way of reliably, part of your policy choice is to have the revaluation model versus the cost model. And part of the year end, you have some way of determining an active market exists, and you have some way that to prove that the price fluctuation of the intangible exists. You can use the revaluation model. So you could mark it up or you can mark it down. And it is uncommon for an active market to exist for an intangible asset. This is quite true. Although this could happen with transferable taxi license, which, if anybody in Toronto or anywhere in the world, those taxi licenses used to trade for 250 grand at least. It's quite an expensive license if you ask me. There's fishing license, production quotas, and then some of them, an active market cannot exist for brands, news. Like if I have a brand, Prep Formula is a brand, I can't do a revaluation of that. And that's sort of the idea of that, again, background around that. Okay, so there's no active market for me to determine how much the Prep Formula brand is worth. Okay, it's probably worth something, but how much? Don't know. And then how do you deal with accumulated amortization at the date of revaluation? Well, it's either restated proportionate with the change in the gross of the carrying amount, so that the carrying amount of the asset after revaluation equals its revalued amount. Aside from all that complexity and confusion, this is my opinion. The frequency of a revalued intangible is so unlikely in the business world, and it's, I wouldn't suggest this is something to worry about and get so consumed in the details on. Okay. Active market, again, so kind of talked about that. You guys are welcome to go through and read the slides related to that. If there's no active market, basically there's no way to value. There's no point hiring a value, like a professional evaluator. The best way to evaluate is how the intangible asset is trading, or whether or not there's an active market for it. Okay, so there's very few markets for intangible assets. So then, that's why revaluation model doesn't exist as much. Okay. Now, what happens if you're choosing to use either the cost model or the revaluation model. Well, the cost model, the statement of the financial position and income statement report the undepreciated cost of the class of intangible asset and amortized respectively. The fair values of the items in the class and changes are not recognized. So if suddenly the intangible value market price goes up, we don't bump that up, and also if it goes down, we also don't bump it unless it's not impairment. Okay, then we will just go through and do depreciation accordingly. Relatively straightforward, consistent with ASPE. And then revaluation, if there's any bump or adjustment, it will go through other comprehensive income. Okay, so if the bump goes up, it will become an unrealized gain in other comprehensive income, and if there's a bump down, then you would have to make those adjustments. I won't go so complex or detailed about this on the revaluation aspect. The focus I would advise you to think about is about the cost side of things, and remember about depreciation. Amortization, that's another part to discuss when it comes to subsequent measurement. So just pulling this back up. So subsequent measurement when it comes to intangible assets include cost or revaluation. Very straightforward. Just talk about costs and say, how to deal with revaluation. Maybe not applicable if it's IFRS. But the other one to talk about is depreciation. The first thing you want to pay attention to when it comes to the case situation is whether or not there is a useful life presented. Okay, you definitely want to discuss the point around if the intangible has a useful life, a determined useful life, or a definite useful life, or if it's indefinite. So if it is definite or indefinite, you've got to talk about amortization. If it's definite, you've got to talk about amortization. And then you choose a reasonable method and discuss why you chose it. Now, if it's indefinite, you're going to open up to another thing called impairment. So you also have impairment on a definite life also, but this is another umbrella to being thorough in your discussion when it comes to subsequent measurement for impairment. Okay, so impairment is another component of subsequent measurement to discuss, and that again is often missed because of that. Okay. Now, what about goodwill impairment? So goodwill is an intangible. It's generated in a different way, which is by the carrying amount. It's basically the fair value of what the assets are, less the difference of the price paid. And if the price paid is higher than the fair value, you have a little bit of a difference, and that difference is plugged as goodwill. And that's actually going to be covered in business combination in the next webinar that I'm teaching. But the impairment of goodwill happens if the carrying value of the cash generating unit or the reporting unit to which the goodwill is assigned may exceed the fair value of the cash generating unit, and that includes any of these significant factors. So I think from your training and practice, you would be able to identify whether or not some situation exists. Okay, so something's not right. The key is not to ignore something's not right. The key is to actually write down what that is not right about. So maybe there's a loss of key personnel. So maybe the main owner has transitioned and died from the business, and that's going to impact the goodwill of the business. So for example, if another company acquired Tesla, Tesla's goodwill is actually coming, the key personnel is Elon Musk. And if Elon Musk leaves Tesla after being acquired, there's possibly a huge significant impact to goodwill. Okay? So just kind of recognizing when you're going through the case situation, seeing what issues are present, but the problem that most people have is categorizing and attributing the problem down to how to address it. Okay. So Ramandeep Kang, interest costs in ASPE, can we include it or not? That is generally a policy choice. Okay. So website costs. The entity's own website that arises from development and is for internal and external access is recognized as an intangible asset. If the requirement to demonstrate how the website will generate probable future economics benefits can be, and where an entity is not able to demonstrate how a website developed solely or primarily for promoting or advertising its own brand, will generate probable future economic benefits. All expenditures on developing the website is recognized as an expense when occurred. Here's a very good example. For those of you who want to start their own practice, let's say, if you ever look at any practice website, there is no benefit, or those websites are pretty lame and dull, right? Like they just kind of talk about why we're such a great firm, or what we have as professional experience, and what services we provide. There is no future economic benefit from it, right? Like it is providing information to prospective clients, but website is not the main mechanism of obtaining clients. Okay, just so you know. Okay, when I start my practice, most people say, Henry, you should be on Instagram, you should be on Facebook, you should be on developing a website and all that detail. No, that doesn't work. Okay, that's not the type of clients that I want anyway. How do you get better clients? Well, it comes from actually referrals. So website is not the medium of exchange. Now, what if you go on Amazon though? Amazon is selling products on that website. Their main way of gaining sales into the company is through listing products on the website and having other third-party sellers listing products on the website. That generates future economic benefit. That is highly probable. So the difference between how Amazon treats their website costs versus how a accounting firm may treat it are actually two very different companies, assuming Amazon is not public. Okay, I assume they're both private. So this is really where it's important to separate the difference between when and how the website costs are being used. Okay. Website stages for website costs. Again, in the case, the most common scenario you'll be given is you'll be given multiple costs related to the development of the website. Your job is to go line by line and to address those points and say what could be capitalized and what could be expensed. And it's not just what you do, okay? It's how you do it and represent it on your writing, and this is important, okay? And again, we'll kind of use this example tonight to go through that. So the summary of intangible assets under ASPE and IFRS. Well, under IFRS, there is the definition stage. Okay, so there's the asset is identifiable and recognizable. Okay, so identifiable, recognizable, same thing. Internally generated assets, it's arising from research or development. So again, this is just repetition to what I just went through in depth, just kind of explaining there's no difference generally from ASPE versus IFRS. Okay. Measurement after recognition. So you see how there's a subcomponent here related to cost model and then revaluation. And you could say something very simple of saying revaluation model is not considered since there's no active market for the asset. Very easy point to score. So I'm not going to go through the mechanics and the details related to the OCI recognition. And then you go through useful life. So useful life is the second component of subsequent measurement to talk about. So an intangible asset with a finite life. You're going to describe, well, the asset has a finite life. You're going to describe and discuss a reasonable method of depreciation. Okay. If an indefinite life, you've got to make a mention that this asset appears to have an indefinite useful life, and therefore no depreciation is taken. So what do we need to worry about? That's going to be impairment. Okay, so let's go kind of to ASPE at a very high level. So this meets the identifiable criterion, same thing. Meets the recognition, same thing. Measured at cost, internally generated intangibles. Again, this is all sort of repetition to what kind of we talked about earlier. And then conditions demonstrated to recognize as an intangible, technical feasible, all of those criterion, the 6 development criterion. That's really what I'll say. Okay. Cost of a recognized intangible is expenditures incurred from the date when the intangible asset first meets the recognition criterion. So this is why it's important to work through the front steps first. So definition, identifiable, recognition, and then you're going through the criterion. Okay. Amortization, intangible assets with a finite useful life. You're going to use amortize over a period, indefinite, no different, but this is not within the scope of this webinar of impairment, but the impairment is tested whenever events or circumstances change indicate that there is a asset carrying amount may exceed the fair value. Whereas in IFRS, you've got to test for impairment every year. ASPE is only if there's an event for you to trigger that. Okay. Goodwill, recognized when it first happens, and then less any write-down. So again, if you want to know how the initial recognition happens, attend the business combination webinar that would be happening. I think it's this Thursday. Recognition impairment of an impairment loss of goodwill, pretty much the same thing. Under ASPE, again, there has to be a event or circumstance for you to do that work to determine that there's carrying amount greater than the fair value. And impairment loss is recognized when the amount is equal to the excess of the carrying amount of the reporting unit over its fair value, and then an impairment loss is not reversed if the fair value of the reporting unit subsequently increases. So to make everybody's life simple, I have a summary here. Okay, and this is the summary I would recommend that you follow. So Chu, Yu, Ku, what's the difference between private and public co when analyzing website costs? Generally no different, actually. The analysis is, for the most part, the same, except for private co, they actually have a policy choice of to capitalize or expense. Should we use SIC 32 when analyzing website costs or stay within IAS 38? I would be honest with you, my opinion is for you to stay within IAS 38 just to keep things simple. It is an A topic, but they don't, I generally don't, I have not seen anybody generally jump into SIC 32. Generally SIC 32 covers, generally IAS 38 covers the complexities of a website. So hopefully that helps answer their question. So if I were in your shoes, I would take this summary and find out the section. So this is written for IFRS, okay? But take the sections related to ASPE and find the same paragraphs to them, so I can locate them in the exam fast enough, okay? Then I would also find the criterion from ASPE and IFRS, those paragraph numbers, and mark that up here. So let's kind of just show what I would do as an example. So if I were doing ASPE, oops, recognition and measurement, here we go. Okay, so I would write on the left hand side 3064 paragraph 21. On the right hand side, I would do my IFRS. So let me just go to IFRS. IAS 38. Go into recognition and measurement. And then right here, You see how it matches right there? Isn't it amazing, guys? IFRS and ASPE are the same, so you only have to study it once. And on the right-hand side, I would write IAS 38, paragraphs 21 and 22. So that if in the case of any danger, and I'm stressed in the exam, I remember where to jump to for that. Okay. Use this as a cheat sheet tool when you're solving your financial reporting related to intangibles. Now, you don't get this in the exam, obviously, but you want to practice using it so that you practice enough, you remember it. Okay, so this is when practicing properly comes into play. Again, I will do the same thing for internally generated intangibles, the 6 criterion here, work through that. Then you have subsequent measurement. So remember, definition, is it identifiable? So here's the sequence of how I would work through that. First, go through the definition. Identifiable, it's separable and arises through contracts. Second step, recognize if, probable, and can be measured. Third step, move into internally generated intangible, 1, 2, 3, 4, 5, 6. Fourth step, subsequent measurement. Talk about amortization. Talk about depreciation. Talk about if it's IFRS, cost or revaluation model. Conclusion, done. If they give me costs, then I'm going to go through those costs and say capitalize expense, done. Okay, and so you can see the intangible asset is a relatively straightforward technical topic when it comes to financial reporting, but it just takes a long time to do it. And dealing with it in a time-constrained exam could be tough, and so you've got to be smart in terms of doing it. Okay. So how do we use this in case writing? Let's kind of work through a case. First, okay, so a couple of financial reporting basics for us to set up before we kind of go through the question. Definition, typically a weakness from a financial reporting perspective. Look for obviously wrongly recorded financial accounting transactions. Criteria is key for success, and no section numbers are required. So, Vahid, is it okay to copy materials of handbook into answer sheet? I think you're talking about the response. It is okay. It's not required, but again, it's okay. Formatting, identify the issue and discuss it. Okay, this is usually because the simulation asks for advice for a particular issue. They are accounting for incorrectly in the simulation, or some other case facts points that you want to discuss. Analyze it. So is the accounting for this issue correct or in compliance with IFRS or ASPE? So ask and answer whether the accounting is correct. Support why with case facts and give reasons based on the handbook, or if guidance is not provided, then based on the conceptual framework definitions. What is the correct accounting treatment? Although, are there alternatives? So in intangibles, there's 2 alternatives, right? There is expense or capitalize. You've got to argue both sides. So you've got the criterion to work through. What's really important is those criterion, the development criterion, all must be met. Okay, and that's actually quite black and white in terms of alternative for that, but at the same time, in ASPE, you have the option, policy choice. The key is just being consistent with it, okay? So consider whether there's further information. When we get into financial reporting, just to kind of pull into it, always think of the journal entry and use criterion. Don't just jump into the answer. The most common thing I see, especially in day 3 marking, is people, when it comes to intangible asset, they, from in their head, which is valid and so, but it's not enough, okay, is they just jump into, these costs look all like development, capitalize. The answer could be right, but they didn't show their work, and they won't get evaluated properly for that. So they're not playing or demonstrating their professional judgment. And this is why you write cases, not why we do multiple choice exams. The CPA is testing how well you are able to use the case to solve the problem. And so there's a lot of mechanical issues that I'll hope to demonstrate here today. But aside from working all the criterion, the last thing that a lot of people actually miss is the journal entry. And if we work through financial reporting, we've got to work through these 5 steps. Where does this transaction fit? The intangible, is it an asset or is it an expense? Is it short-term or long-term? Actually, it's most likely long-term, right? Recognition, do I have permission to record this on my financial statement? So all these costs that have come in, do I get to record them? How much do I record it? So I've been given a list of costs. How much do I capitalize? How much do I expense? Subsequent measurement, what updates do I need to do afterwards? Do I need to do cost or revaluation model if it's IFRS? Do I need to do amortization because there's definite life or indefinite life? Do I have to worry about impairment? So that's subsequent measurement. And then lastly, again, is this short-term or long-term? Do I have any notes to disclose? So this is what a depth topic looks like. Not just one of those components. Okay, so most people will just cover, let's say, recognition, maybe a little bit of measurement, and then that's it. Okay, so thoroughness is the key. And if we think of the role of financial reporting, the role of financial reporting is to figure out how much I need to record and where. If you don't know the journal entry, then you're doing all this work, but you're missing the point. Okay? Recommend and conclude. Consider impact on other areas, hook or big picture, and I'll kind of talk about that. And then lastly, maybe you might need to tie into other competency areas, like dealing with tax consequences, or other accounting alternatives, or even assurance procedures. Okay, so I just kind of want to open that up before, and just apologize while I kind of set up for my discussion here. Okay, so here's the response, and here's a question. Okay, let's kind of talk about how we would approach this question. Again, this isn't a full case course. I'm not debriefing or working through an entire question because it does take 80 minutes to work through it. Even a trained individual like myself would take a long time. But I still want to show you the reasonability of what can get done with this. Okay, so as I'm reading the case, let me kind of start with planning it. Okay, I kind of want to highlight a couple of key points here. So the first key point I want to highlight is, So Chang ESL is located here. They're recording under ASPE. Located in Toronto, the academy is this. Michael Chang is the president. The date is June 29th, 2016, and has been called into the office. So, by the way, this is an actual CFI case. It was the very first CFI back in 2015. Okay. Evelyn tells you the academy has an eventful year. It started offering courses online, which is a significant change from its traditional classroom setting. Here is a discussion with Michael Chang, which provides information on the new course. Please prepare a memo. Includes an analysis of financial reporting issues. And you should consider, so I'm not going to do this part, you should consider, because that's assurance, and we're not covering that today. Risk assessment, materiality, and approach. Notice how they actually never asked me to do any procedures, so that's why I'm not going to address it. In this class here today. After a number of years of profitability, actually I'm going to do a little bit of it just to bring that together. Sorry, just bear with me 1 second, guys. Okay, so just gonna write In October, it started offering courses online, which is a significant change from its traditional classroom setting. I'm just going to highlight something here. Significant change. Users and objectives. Michael Chang, President and sole shareholder of the Academy. Assessment. Please. Memo that includes an analysis of any financial reporting issues resulting from this change. AO, you should consider the impact of this change on the risk assessment, materiality level, and approach. Oh, actually, I'm just going to do this part, okay? I want to show you guys a couple of points. So going back to the slide, tie into relevant assurance procedures based on case facts and tax implications. So kind of have a draft plan created here. After a number of years, Michael is considering, I swear, just a small side note, guys, I swear this case is almost like prep formula's case. It's a case on prep formula because the name sounds quite familiar. I don't know if you guys know a certain guy named Mike. But anyway. Okay, so there's that, and he's unsure whether he should offer additional courses. Michael is unsure whether it should offer additional online courses or more of its traditional classroom courses. Okay. So reading the case, here's actually where the assessment, so here's something where we're talking about some online courses, okay? In 2015, the Academy launched 4 online courses. Students access the courses online via the Academy's learning site, which then redirects them to external website. Online courses use a combination of this material. Each online course is comprised of these modules. Each quiz must be completed successfully between the next module. After completing all the modules, they get a certificate. Sounds like you guys, right? The content of these online courses is similar to an introductory classroom. Classrooms run 8 weeks, delivering 1 module each week. The online format, however, allows students to complete each module at their own pace. So there's a difference here, so I'm just going to point that out quickly. Students are given a username, password for each course, valid for 90 days. I'm going to write that down. Oops, my mouse is a little bit wonky. Sorry, guys. While taking the course, students can view all the course material for the current module and from all previous modules can view all. To assist students when needed, online tutor support is available throughout the course after 90 days of the course, whichever is sooner. Students no longer have access to the material and it's expired. I can't underline expired under my software, unfortunately, so sorry, guys. The registration process for the online course is the same. For the classroom, registration is the same. And students pay for each course in advance. Okay, so normally I would highlight this, but I can't. Underline that. Students can register for online courses at any time, receive their course username and password registration. Tuition for each course is $150. All payments are non-refundable once a student accesses the course online. So, what do we have here? We have an assessment opportunity. Oh, that's related to revenue. Okay, so this is an example of something that I'm reading related to revenue. Now, just keep reading registration and completion statistics. here's sort of all related to revenue. So now let's get into, so that was one assessment opportunity related to revenue. And just kind of an example, okay? The problem is this recorded properly? We don't know, right? You can see the assessment opportunities, please prepare an analysis of any financial reporting issues resulting from this change. What I want you to know is they're not going to say, please write an assessment opportunity on revenue. Please write an assessment opportunity on development costs. You've got to determine whether or not the accounting was correct or incorrect. So now let's go into the online course development, and I'll kind of show you. This is the development cost case information, by the way, and I will show you how to determine whether or not this was right or wrong and whether or not you needed to analyze it. Okay. So in January 2015, Michael commissioned a market research into the demand of online courses. The study costed $330,000, and indicated there's a significant. Actually, I'm going to do this. Indicates significant demand, which would allow the Academy to expand its customer base. Actually, let me kind of go back to a point up above. Considering opportunities to further grow the business. I think I missed this highlight. Oh, I remember. I couldn't highlight it. That's why I missed it. Sorry, guys. After a number of years of profitability, to grow the business. Development on cost of online course and platform development indicated $30K research study indicated significant demand for online learning, which would allow the Academy to expand its customer base outside of Toronto. With tuition of $150 per course, study projected that online registration would start at $400 per course and would increase to 40%, 2 to 3 years, and then stabilize. Based on the results of the study, the Academy developed a detailed plan for the course. They can't underline that part. The Academy's projection on the profitability of the online courses were based on market research, which supported recovering the cost over the year. Again, I can't underline it, unfortunately. The Academy contracted a programmer to work with its instructional designer and teachers in order to develop the course content and so on and so forth. The costs incurred are as follows. Here's a whole bunch of costs. Website, web hosting, and IT for a course are outsourced. $6 per course. At December 31st, the Academy recognized an asset of $258. With respect to the online courses and related IT platform, Michael is pleased to have the value of the course as he believes they represent a significant value and valuable asset. Michael has confirmed with CRA that the cost does not qualify for SR&ED treatment. However, he is wondering whether any of the online courses and IT platform development can be deducted, or if capital cost allowance can be obtained. So here we actually just picked up another assessment opportunity. Okay. So you can see how quickly I actually was able to read through this and mark it up and know how I want to use the information. This kind of, again, takes practice and comes from proper practice. And this is what I make specific, what are one-on-ones with my mentees. This is what we do. Okay, so they get trained to know how to pick this up one by one. And you guys are also watching this happen live. Okay, so now we have a good amount of information related to it. And I just kind of, you'll see sort of, this is a shell of an outline that I have here. And I just kind of want to start setting up my response. Okay, so issue. Whoops. That's not what I wanted. At December 31st, the Academy has recognized 258K in its balance sheet, an asset with respect to the development of its online courses. Oh, by the way, to tie back to the point that I was talking about, how do I know that this is something to address as a separate assessment opportunity? This is why I highlighted this. Michael is pleased to have the value of the course reflected on the Academy's balance sheet, as he believes they represent a significant and valuable asset. Well, let's kind of take a step back and look at that. Should it be capitalized or should it be expensed? Do we agree with him or do we not? I don't know. All I know is he capitalized it. Something could not be right here. Okay? That's how you make the connection from please prepare any financial reporting issues resulting from this change into how do I get to do development cost. Okay? The issue is whether these costs meet the definition of an asset, and if so, should it be capitalized or expensed on the financial statements. Analysis. So to make it a little bit fun for you guys, I will pull and use the handbook instead. So I am in ASPE, so I'm going to go to ASPE. Intangible assets, identifiable. Pull the criterion here. Whoops. Just going to set up my response. Control, so identifiable. Control. Future economic benefit. Again, I'm just setting up my response, guys. Recognition and measurement. So go see those criterion. Okay, so I'll go there. And this is oops, let me just do this. there's that part. And then lastly, development costs, research costs, research, development. Okay, so my answer is all set up. Let's get this going. All right, so it's 9:20. I set up my answer question in I think about 2 minutes. And let's get this going. And I'll kind of narrate while we go. Courses are separable and could likely be sold to another school, right? So let's just use prep formula as an example. We could sell the course, any courses to people, just to, we just sell them the content and then they can work through that, right? Control, yeah, actually I'm just gonna do that here. Control, let me fix the content on this, the formatting, sorry. The academy has developed, oh, my typing is not good today too. The courses and has the exclusive right to deliver the course. They enter into contracts with designers. Oh, actually, let me show you where I'm getting this from, right here. Okay, enters into contracts, designers, and teachers to develop the material for them. This is met. Before doing course development, the Academy commissioned a market research study on the demand for the price and pricing of online courses. The results supported the belief that the course would be profitable, therefore supports its recognition on, recognition as an intangible on the balance sheet. Met. So a couple of things, again, just to pay particular attention, like I mentioned in our slides, the assets are going to flow into the entity, okay, so the benefits, sorry. And before the development, the Academy commissioned a research study and indicated there's significant demand for these and pricing the course. The results supported that it would be profitable. Okay, with this suggested the projected that annual would have 400 registrations and would increase by 40%, which in each of the years 2 and 3, and then stabilize. So there's clearly some benefit from doing this. Okay, the next part is going to recognition and measurement. So here, discussed above, costs can be measured reliably, and this is met since there is a developed budget for the development. There is a budget for the development, and costs are tracked separately, discussed below. So, remember reading the case down here, it's right here, for $258K in total. Research, I am going to say, scrolling up here, by nature, costs related to market research spent was $30K, and since it represents market research, it must be expensed. The Academy has recorded this incorrectly, adjusted for expense. Go to conclusion. Debit research expense 30K. Research expense should market research costs for 30K should be expensed. Development costs. Now we got all this criterion to work through. So here, technical feasibility. Is there enough feasibility to complete? Well, the completion of the course is technically feasible. Notice how I'm reusing the words in here, okay? Because the Academy has an instructional designer and ESL teacher on staff with the expertise to convert the content for delivery, online delivery. It is a matter of assembling content and constructing and packaging it. Although there is no programmer on staff, this is the nature. Programmers are normally can be hired on a contract basis to help out. For MET, intention to complete after the study. After reviewing the study, the Academy has intent to complete because they always have had because they want. So something I'm going to pull up here. Because after a number of years of profitability, Michael is considering opportunities to grow the business. This fits what he's looking for. I don't know why it formatted that way. Ability to use or sell the intangible asset. Academy has existed for many years. It had previously established a plan for launching the online courses and the related IT platform, thus giving it the ability to sell courses online. This is met. Next criterion. There is adequate technical resources as described above with the designer and teacher in-house with external programmer. Financial resources are available to utilize their services. Therefore, this is met. The Academy tracked all expenditures attributable to converting the courses online with an internal allocation as described below. Will they generate future economic benefit? there are projections provided by the market research study indicating number of registrants to be 400 at 150 per course. This is so 150 times 400 is 60 grand per year, growing at 40%. So times 2, 3, so 3 years equals 180. Is that right? 40, oh, registrants per course. Okay, actually, per course over 3 years. If more than one course is being developed, this clearly exceeds cost of development of 258K. Okay, so now of all those course costs, market research costs, based on the above, clearly the intention of building courses can be capitalized as intangible and matches Michael's belief that they represent a significant and valuable asset. Market research costs, 30K, as discussed above, expensed. Programming, 75K. Capitalized because of above. Allocation of salaries, 105K, 5K as per above. Actually, let me do it this way. Expensed, capitalized, since meeting criterion above. And production costs, 35K. Marketing costs and web hosting, 10 plus 3 equals 13K expensed because considered as maintenance. Subsequent measurement, Academy has to determine the useful life of the course. Let me just make this a little bit bigger. Including whether it is definite or indefinite. If it is definite, it would be amortized over the useful life of the asset. And then total costs to be capitalized equals 175 plus 105 plus 35 equals 215. Debit, no change on, since it's been capitalized, no change on 258, but debit 258 minus 30 minus 13. Oh, sorry. 30 plus 13 is 43. So maintenance web hosting expense 43K. Credit intangible development costs 250 73K. Done. So that took about 15 minutes to write it. As you can see, 15 minutes to go through writing it in detail. This is long, guys. Let's kind of look at the amount of words here. Okay, that was 1,200 words in 15 minutes. Okay, it's not easy. All right, but this is what depth looks like. If we kind of recap what we talked about tonight in the webinar, if we look at the webinar, you can see I went through the definition, I went through the recognition, I went through the development costs, and then I went through, I didn't talk about this because it's not IFRS, and then I went into indefinite or definite to talk about subsequent measurement. Okay, so this is also the same way I mentioned in here. You can see I have the definition and identification, recognition and measurement, and then subsequent measurement. And then, lastly, conclusion, presentation and disclosure in this topic may not have been as necessary. And maybe that's what I give up, given what I was going through. Okay, so hopefully you guys can see how complex this gets. Now, let's kind of tie in some additional stuff to talk about. Tie in other competency areas. So add in relevant assurance procedures that are doable and are based on case facts, and discuss tax implications of different accounting alternatives. So if we go back to this case, if you remember back on my plan that I put in here, there was a point here. Please prepare, oh, sorry. Where did it go? Oh, actually, down here. You should consider, actually, let me highlight this so I can make sure I don't miss it. You should consider the impact on this in the change on the risk assessment. Well, since I've already written the, let's say I'm writing my separate assessment opportunity related to, let's see, okay. Risk assessment at the overall financial statement level. Whoops. New online courses. Since online courses were introduced in 2015, it is unlikely that the revenue recognition policy and the capitalization policy for intangibles have been fully considered as demonstrated above. For revenue, I didn't do that right, and intangible, there is an adjustment for 73K. There could be possible other adjustments. This increases risk of errors. Okay, so I've already addressed a portion of that. So that's an example of how, just by coming in with this part here, just by doing this, I've used the result of my analysis from accounting into my audit. Okay, so just again tying back to making sure that add in relevant procedures or different alternatives consider the impact on other areas, consider how this accounting may impact other areas in the case. So this impacted my risk assessment when it comes to doing an audit, okay? So that's there. Now, there's also another one related to the tax, and I actually didn't copy that down, so let me copy that down. AO. Michael is wondering, wondering whether any of the online course and IT platform development costs can be deducted, or if capital cost allowance can be claimed on the income tax return. So you guys are getting a little bit of a bonus tonight to go through. For me, I just went through I'm supposed to only go through financial accounting related to the intangible, but I want to show you how these cases are actually integrated together. And it's not just answering assessment opportunity by assessment opportunity. People may miss, this is an easy point because you've already done the work. Use it, right? And so I just kind of want to show you the synergy and the special way of finding how to improve your writing from the work that you've already done, right? Like the key is knowing how to use the case, but at the same time knowing how to use the results of your case. Again, this is stuff that I work with my mentees to work with. Okay, so again, this is where you want to use and talk to your mentee. Okay, all right. So now let's write this one. I'm just going to write issue. The issue is whether the costs, oh my goodness, can't type today, can be capitalized for tax purposes or not, and if they cannot, can they be deducted as an expense? Analysis for financial reporting purposes, it could be acceptable to be capitalized. However, for tax purposes, CCA could only be claimed on depreciable capital assets. Costs added to the CCA pool would be programming, $75K. This would be class 12. Production costs, $35K. Salaries, $105K. While the salaries and product costs are used for the development of the application software, you can argue they can be fully deductible versus the 12% versus the CCA rate for class 12 is 20%, 50% in the first year. Okay, so that's 75 times 0.2 divided by 2, 7,500. 75K times 20% times 50% equals 7,500. Oh, whoops. Should be 35 plus 105. 35 plus 105 is 140. Is 140K. 140K deduct. Sorry guys, a little bit messy. Kind of doing it on the spot, but it is what it is. 14K. No, is that right? So 140 times 0.2 divided by 2 is 14K. Okay, so 14K. Clearly, it is more advantageous to deduct this for the 100%, as it can be argued it is used for producing income. These costs could be capitalized. Oops, no, not that. Okay. Other costs as discussed above for accounting. So 43K related to web hosting, IT software, marketing, and research costs. Should research costs of 30K is aligned to be expensed or deductible for tax purposes. Conclusion: not all development costs can be added to the CCA pool for tax purposes. As detailed above, programming costs would be added to class 12. But the other costs can be expensed for tax purposes. Done. So me doing this whole AO with the narration with you guys, I started at I think 9:20, and it took me about 30 minutes to write two and a quarter AO. So this one took the longest. That was 20 minutes. This one took less than 2 minutes maybe. And then with the narration, writing this whole one here took another, I forgot, 20 minutes plus 2 minutes, yeah, 6-7 minutes. So average out over the AOs is about or so. But anyway, okay, so hopefully you guys can see the detail that I've went through in terms of writing this, and going through using the case information. Like you guys are seeing me work on this live with the case right here and just writing it. Okay, this is the difference between somebody who actually is heavily involved in the exams, and this is what a lot of the prep formula mentors have. Okay, so they're very well involved. Be very, very careful of other advice that you get from elsewhere. Maybe the intention of the advice is quite nice and helpful, but in this world there's a whole bunch of resources and advice out there. The key is actually getting the right advice and using it properly. So there's a lot of questions that are that were posted. I'm just gonna answer those one by one first. Can I please save the answer? So first of all, the answer is actually down here. There is an answer down here. So if you go through here, this is in the CFE board report, so you can see the answers down here. This is written actually very, very well. It shows you exactly the handbook sections, tells you the details on how to write it. This is just my style, okay? And you guys can watch the recording for that related to it, but I have posted the solution basically coming from the board report for this. and you can see the details. So let's say the intangible, they actually started it this way. They went through all these costs. It's unclear what it is. The issue is, however, whether or not what should be capitalized or expensed. They actually talked about it from an inventory perspective, which is interesting, but I didn't go through that. And then they went through research phase, development phase. You see how they went through the criterion all here, the 6 criterion. Overall, with the breakdown of the costs, they came out to be the exact same as me, which is nice. 215, 43K here. That needs to be expensed. And then afterwards, so you talked about subsequent measurement, just like as we talked about here. And then let's kind of go through the risk assessment. So look at that, new online courses since 2015 has been fully as a result. Looks pretty close and same. Interesting. And then you have the tax. Let's see if they have the tax down here. The tax. Okay, here. So here's the tax. Oh no, that's strategy and governance. Okay, here's the tax. Wondering the issue. Actually, I didn't actually write that conclusion, so therefore is incorrect for Michael to believe you could deduct CCA on all okay. So again, you can see he's gone through the answer again, just compared to mine. Theirs is a little bit more detailed. Okay, I don't have the tax session. Unfortunately, this is not related to a tax webinar, but my kind of personal side advice is, under exam conditions, the amount of tax you need to know is important, but the depth is unknown. Okay. Navigating the Tax Act, I just want to cover that really quickly, is a jungle. So know your tax rules really, really well. And Prep Formula has a 4-hour tax course, has a very thorough tax course detail of the sections. Definitely go through and learn that part. Okay. All right, so that kind of pretty much covers the details of addressing a little bit of planning, a lot about the reading of the case, okay, and pulled out specific areas outside of just answering the assessment opportunity. I answered the assessment opportunity live for you, showed you a very comprehensive level A depth response, going through very significant components of definition, recognition, measurement, subsequent measurement. I also showed you guys how this may impact other areas, and it impacted other areas related to the audit, okay? And that also showed you adding, tying into other competency areas and talking about the tax implications and the different accounting alternatives. This is actually a very perfect example of what it looks like. It's a very challenging day 3 AO, by the way, but this nothing kind of represents more than the actual exam. So if you haven't done this question before, try not to study what I just have gone through, and try to attempt this yourself and kind of see how this ultimately goes. You can see there were 8 assessment opportunities to be done in 80 minutes. Can you do this all right away? No. Can you cram it all right away? No. You've got to practice into it and make the right progressions. If you make the right progressions, you can address all of the 8 assessment opportunities, and you should address all the 8 assessment opportunities in the right amount of time. And when most people say, "Oh, I'm having trouble with my time, I'm having trouble finishing my case," and then I ask them, "What do you need to do next?" I was like, "I need to write faster. I need to do better." That's too vague and ambiguous. With my mentees, we break down specifically the problems. Do you have challenges with your technical? Do you have challenges with your case writing mechanics? Do you have challenges with managing your time? Most people just see it as managing their time, but there's 3 components that you have to be very good at. And so this is what when you watch these webinars, watching an experienced individual go through this really makes the difference. Okay, so that pretty much wraps up what I wanted to talk about tonight. Hopefully you guys appreciate the details that I went through. I do apologize for the rough start for making a lot of you wait because of the confusion, but hopefully you found this session or this webinar worth it. And if you guys really like this webinar, please do leave me a positive review. I do look at them and know what we need to do and plan next. And that's it for tonight. I appreciate you attending and watching this webinar late at night live. Hopefully you guys took away a lot, and thank you. Have a good night.